Hi, I'm Jamie Duncan,
I'm Joe Delasha.
And I'm Emma Farina.
and we're going to discuss IFRS and GAAP on the balance sheet between four companies, GM and Volkswagen, and Fujitsu and Dell.
The first company is Fujitsu. It's an IFRS company. They're based in Japan, and they're currently the fourth largest IT company in the world. They have services available in over 100 countries, and the revenue last year was 4,762.4 billion yen, and that converts to $40.2 million. Next company is Dell, which is a GAAP company based out of Round Rock, Texas, and they're in the computer software and computer hardware industry, and they develop, sell, and repair computers, and they're one of the largest technological companies in the world, and they have plants in over 45 countries worldwide.
Up next is General Motors, or GM. It's an American company that designs, manufactures, markets, and distributes vehicles, parts, and financial services. It does business in 120 companies and produces cars in 37 under 13 brands, and my father works for them. Next is Volkswagen. It follows IFRS. It's based in Germany, has factories in 19 countries, and its headquarters are in Wolfsburg, Lower Saxony, Germany. It has 100 production companies across 27 countries, and it does services in banking, financing, fleet management, insurance, and leasing.
Next, we're going to talk about the general differences between IFRS and GAAP. IFRS requires a separation of current and non-current assets and liabilities, while GAAP only recommends it. This becomes an issue or it allows IFRS to have like a deeper look, like requires a deeper look into a corporation's finances, while GAAP is only like a recommendation, so there's a little more room to move amounts around. And for inventory, IFRS only allows FIFO, first in, first out, while GAAP allows both FIFO and LIFO, which is last in, first out. This is also an issue because LIFO allows you to have a greater expense for your inventory, so you can lower your income and then pay less taxes when FIFO does not really allow that much room for changing amounts, and so then IFRS, you can't like sneak around as much money.
Now we're going to compare the two companies, Dell, which is the GAAP company, and Fujitsu, which is the IFRS company. Some of the things that we can compare. Dell's balance sheet is shown in American dollars because they're an American company, and Fujitsu's balance sheet is shown in yen because they're a Japanese company as well as American dollars. Dell lists their balance sheet in quarters, while Fujitsu lists their balance sheet in annual listings. And then again, Dell and Fujitsu, IFRS company, lists shareholders' equity under net assets, and Dell, the GAAP company, lists shareholders' equity under total equity, which is a reason why GAAP may be a little bit easier to understand. Also, Dell lists current assets, non-current assets, and intangible assets in that order, while Fujitsu lists current assets, property, plant, and equipment, intangible assets, and investments and other non-current assets in that order, which also may be a reason that GAAP may be a little bit easier to understand.
Now we have GM, which follows GAAP, versus Volkswagen, which follows IFRS. GM lists current assets and then non-current assets, whereas Volkswagen is the other way around and lists non-current assets and current assets. And GM lists all liabilities and then equity, whereas Volkswagen lists equity then liabilities.
We feel that the most important part of the balance sheet is the current asset and current liability section. We think that they are the most important because you can calculate the current ratio and your current debt to asset ratio, which tells you how much of your assets are funded by debt, and rather you're just like fully owning them. And this is beneficial in analyzing the company's financial status. We feel that GAAP is easier to understand because they list the assets and liabilities in the order of liquidity, so you see what is most easily converted to cash first, rather than IFRS, who lists them in reverse order. So if you want to see what kind of cash a company has on hand, you have to go all the way down to the bottom of their balance sheets to figure that out. And then, although we think that GAAP is easier to understand, IFRS we feel gives a better view into a company because they are more strict on how to display their accounts, with like inventory and how they strictly tell companies to separate their current and non-current accounts. So we feel that IFRS is more transparent, gives a more transparent look into a company. And these are our sources. Thank you.
Thank you.